So what are your thoughts on hidden taxes?
Mumbai gives around 30 to 33% of taxes, total collections. Air India, for example, right? There are innovative routes in which this investment has happened.
This is Adhitya Srinivasan, and this is the Private Office Podcast. In the Tax Experience series, we aim to make tax knowledge more accessible and less terrifying. This episode is brought to you by Synergy Gulf from Dubai. I have with me Mr. J.B Mohapatra, former chairman of the Central Board of Direct Taxes. Thank you, sir, for joining us. In this episode, we will review the tax landscape in India. Let's get started. So maybe a good place to start is to just understand what a tax is. So how do you define a tax?
Tax in general parlance would mean a compulsory levy by the government for providing the common good to the people. It is a levy which one cannot escape, and it's a levy which is used for the purposes of the government.
Right, sir. And what would you say are the various kinds of taxes in India?
At the central level, we have the direct tax and the indirect tax. And the direct tax would comprise, apart from income tax and the corporation tax, also something called the equalization levy, which is imposed on the non-resident Indians in certain cases. And then you have the securities transactions tax, which is a turnover based tax based on the securities transactions which happen in the stock exchanges. So these four components comprise mainly the direct tax. In the indirect tax, you have the central excise, then you have customs, then you have the goods and services tax, the GST. So these comprise the indirect tax.
So the broad categories for direct taxes are four: income tax, corporation tax, equalization levy, which is only for non-residents, and securities transaction tax.
Absolutely.
So four categories of direct taxes. And for indirect taxes, we have central excise, customs, and GST, or goods and services tax.
Absolutely.
So perhaps we can then talk about what is a direct tax and what is an indirect tax. Why are they called direct and indirect respectively?
Direct tax, as the name goes, it's paid directly by the one who is required to pay direct tax. You cannot shift the direct tax burden on your neighbor. When it comes to indirect tax, it is basically a consumption based tax. If you consume something, either a good or a service, then you are saddled with a consumption based tax. But this tax, the indirect tax, it can be shifted to the next in line, right? You pay taxes, but it can be shifted to somebody else, and it is also not direct in the manner of income tax. Only in services which are excisable or brought under the GST or under the customs levy, that the tax can be imposed. Direct tax in that way is something which is imposed directly without any chance of that levy being shifted elsewhere. But the indirect tax is based on the choice of the consumer to imbibe or consume a good or a service, but in cases also it can be shifted to the next consumer of the services or the goods which is being consumed by the taxpayer.
Right. So broadly, with respect to indirect taxes, there seem to be two features which stand out. One is that indirect taxes may be levied on someone, but they may ultimately be borne by someone else. And secondly, the amount of indirect tax which someone has to bear is a function of how much they use a good or consume a good or a service or whatever it is. I think broadly these seem to be
this thing. And another important feature or the difference between the direct tax and the indirect tax is that direct tax is inherently progressive, in the sense higher income you go, the larger amount of taxes that will be your payout burden. But in indirect tax, so far it has been administratively impossible to devise a calibrated consumption tax. A rich man would be paying as much for petrol or diesel as a poor man. So it does not differentiate. There is no progressivity in the indirect tax so far.
Is there, just to take that particular question, I think your point on how some goods are common across the population is well taken. However, are there any goods or services which are extremely sort of, let's call them luxury goods or luxury services, in respect of which it's possible, at least theoretically, to impose a higher rate of indirect tax? And has that been done, or?
No, it has been done. Like, the GST rates would be 0%, 5%, 12%, 18%, and 28%. Luxury goods and sometimes they call the sin tax.
Right.
The highest bracket, they are solely preserved for the luxury goods, the 28% GST rate.
But your point is that despite trying to do this, in the sense having different rates or higher rates for luxury goods, which presumably would be consumed more by the more affluent or the rich, it has still not been possible to have a largely progressive indirect tax system because of the fact that there are some goods which are consumed by the whole population, and it's not possible to equalize really.
No, the consumption tax by nature it is regressive. It cuts both the rich and the poor with the same scale. There is no progressivity as in the direct taxes.
Right. So what are your thoughts on hidden taxes?
See, the taxes can never be hidden. If you are suggesting that something is being extracted out of you in a manner which is surreptitious and which you are not aware of, then it is not a tax. Tax, as per Article 265 of the Constitution, is a levy as authorized by law. Without the express approval under the law, no tax can be levied. But I take a point, if I can stretch it a little deeper and farther, I can say that inflation in some cases, it has been regarded as a tax, as a hidden tax, right? So inflation may eat into your tax payouts. For example, to offset the inflation, suppose you are getting a dearness allowance, and because of the dearness allowance, you are moving yourself or your income is moving itself into a higher bracket, then there will be higher tax payouts because you have moved into a higher tax bracket, right? So this is a direct fallout. But these situations will be rare, but it will happen theoretically and practically. These situations will happen. But more than that, income tax lawmakers, policymakers are acutely aware of the inflation eating into your tax payout provisions. That's why there is a constant endeavor to see that they are calibrated in order to offset the effects of the inflation. For example, the standard deductions, which is in section 16 of the Income Tax Act, it was in the 2000, it was like 25,000 and 20,000. And in 2018, it was 40,000. Today, it is 50,000, right? So this is just an example. But in many cases, you have the Income Tax Act calibrating itself in order to lessen the burden of tax payout because of the inflation on the taxpayers.
Right. So I have a few questions relating to this. I think this example about inflation is fascinating. I think one question which comes to mind is that is the extent to which the calibration is done or the adjustment is done for inflation, does it actually reflect the actual, say, levels of inflation that are prevalent at the point of time, or is there some sort of gap in between what the adjustment is and what the actual effect of the inflation is? That's one question I have. And secondly, how frequently is it that tax administrators and tax policy writers are involved in the process of keeping aware of what is happening in terms of inflation on taxes?
No, there have been not only periodic, but there are recurrent checks and studies on how inflation eats into your tax payouts. Just not the example I gave of the standard deduction, but in many other cases, when it look at your the basic ceiling limit, right? It was like 100,000 rupees. Now the highest slab personal income tax will be falling at 30%, right? And at 10 lakh rupees, right? It was 100,000 rupees at one point in time. Now it is 10 lakh rupees, right? So these kind of indexing the deductions and the exemptions to the inflation has been a constant ongoing exercise for the department, but you may as well ask and raise a valid question as to whether the timings are calibrated, right, from year to year. The large endeavor is to calibrate it periodically so that the taxpayers are not deprived of undue taxes on them.
Right, sir. Just to go back to hidden taxes for a moment, there's another example that comes to my mind, perhaps because I have a background in law, and that is where what you see when you read any judgment or any order. Largely, this isn't always the case, but at the very end of the judgment or the very end of the order, they have the sentence saying no order as to costs or parties to bear their own costs. Now, I suppose that's all well and fair in sort of private party disputes. In the case of a criminal prosecution where the state is the one that is instituting a prosecution against an individual, and ultimately at the end of the trial the individual is acquitted of the offense with which he has been accused or she has been accused, it ends up that the individual nevertheless still has to bear the costs. Now, what I'm trying to get at is that these are costs which the individual is ultimately having to bear at the behest of the state. The state has instituted the prosecution. So would you not regard something like this as being a sort of a hidden tax or an indirect tax, not in the sense that we discussed a short while back, but a tax nevertheless, as in an outflow of cash of an individual at the behest of the state?
No, as to whether there is a need to impose a costs on a litigant or not, it is a sole preserve of the judiciary or the judiciary at whatever level the litigation is settled. So, to my mind, to conflate the issues of cost with the levy of tax will be inappropriate. As I said, tax is a levy which is authorized by law under the Constitution. The cost imposed in a litigation is neither a levy of tax nor a levy by anything prescribed under the law.
Right. So let's go back to the different kinds of taxes. So could you perhaps tell us a little bit about how much revenue is raised from each of those categories and maybe subcategories of direct and indirect taxes?
I'll give some broad statistics of 21-22 and 22-23 financial years, right? In 21-22, we have a revenue collection of 14.10 lakh crores on account of income tax and corporation tax, and nearly 13 lakh crores was the collection on account of the indirect taxes, that is customs, GST, service tax, etc. In total 13 lakhs. In 22-23, the collections from income tax and corporation tax were something like 16.65 lakh crores, and on the other hand you have the indirect tax component coming at around 13.85 lakh crores, right? So that has been this kind of mix all the while, right? And the mix is like today the mix between direct tax and indirect tax is something like 54:46, right? And in 23-24 it is projected that income tax and corporation tax in toto they will give 18.20 lakh crores, whereas the indirect tax component would be around 15.20 lakh crores, right? So direct tax as a matter of precedence and what is happening on the field is the direct tax is giving a little more than the indirect taxes. I remember except for 2 years, in 2016-17 and in 2020-21, where the indirect tax jumped over the direct tax, which was held to be not very favorable to the progress of the economy, right? but now the regular delivery of service has started, and from 52:48 in 21-22, now we have moved into a 54:46 ratio in 22-23, and going forward, I believe that the fact that the direct taxes will outnumber the indirect taxes is a healthy trend going forward.
So why do you say it's a healthy trend? And what effect does it have to the progress of the economy?
Now, as I would have told, and I will reiterate it here, that indirect tax is inherently regressive. It cuts the rich and the poor with the same brush, right? And it is not calibrated to the income which you earn, right? In emerging economy, the proportion of direct tax is to indirect tax. It's a good it's a good ratio to look at the progress of an economy, right? In developed countries or the industrialized countries, the ratio which you see now is just the opposite. There, the income tax and the corporation tax is much higher than the indirect tax collections. And within the direct taxes, you have the personal income tax much more than the corporate income tax, right? So these are signs of developed economies, right? Where personal income tax is more than the corporate tax, where direct tax collections is more than the indirect tax collections. That shows the stage of development of an economy. We are at a stage where our direct taxes are outnumbering the indirect taxes, but within the direct taxes, the corporation tax and the non-corporation taxes, they are almost of the same range. As we grow further, our personal income tax collections, they will increase more and will be moving to, from the emerging economy, maybe we'll be moving to a next stage of development.
So you make a lot of interesting points over there. I think the first point is that as long as direct taxes is outstripping indirect taxes, it reflects some sort of progress in the economy. So right now we have 54 to 46. It's projected to maybe go up to 57 to 43, or maybe something along those lines. If one were to say that our direct tax to indirect tax figures is say 65 to 35, that would signify, sir, according to you, more progress or better progress of the nation?
I can't hypothesize. I can't give a hypothesis as to in what directions the collections will emerge. But the stage of development of an economy, looking through these numbers, would show that India is moving slowly but confidently towards towards a solid economy, where the indicators of the government's revenue being sourced from the direct taxes is a healthy trend.
Right. The other thing I found interesting, sir, is that you mentioned that within direct tax collections, the share of income tax and corporation tax is roughly the same. And perhaps as income tax starts outstripping corporation tax within the direct tax collection figures, that perhaps signifies that the economy is doing better or there's more progress?
India is should be slowly moving in that directions. Our number of individuals who are filing the returns is huge. Nearly 96% of the total taxpayers would comprise individuals alone, right? And as prosperity happens in a meaningful manner, in a deeper manner to those people, then the personal income tax collections would go up. So I can see progress happening to the personal income tax and the non-corporate segment of the direct tax collections in the years to come.
Yes, and I suppose as you have the personal income tax outstripping the corporation tax, it perhaps signifies at some level that there are more individuals who are paying taxes, and that in turn perhaps symbolizes the fact that their own prosperity is increasing. And that's the takeaway. So now the government raises taxes, and naturally these taxes which it raises is being spent. So it's public expenditure, so to speak. Is all of the money that is used in public expenditure raised from tax revenue?
Okay, so that's an interesting question, and some facts and figures they are needed. And let me give you the numbers for 22-23. in which, as I told, direct tax and indirect tax brought in nearly 30 lakh crores of taxes, right? Out of that, the state's allocation, nearly 9 lakh crores went to the state's allocation, right? So that left something like 21 to 22 lakh crores of what we call the net tax revenue, right? This is not sufficient to meet nearly 40 odd lakh crores of demand of various ministries and the departments who are vying.
It's just about more than 50%.
Yeah, correct. So and here there is the requirement of the non-tax revenue, right? Non-tax revenue of 22-23 was something like 2.61 lakh crores. And add to that the borrowings and the loans which the government takes, which was like 18 lakh crores this year, right? And out of the 18 lakh crores, 14 lakh crores was the market borrowing, 4 lakh crores borrowings were from the small savings, and so these will be the market borrowings. So to augment the budget in order to cater to the demands of the running of the government, the requirements for the running of the government, run its schemes and its programs, its share in the centrally sponsored programs, its 100% involvement in the central sector plans and programs, its establishment expenditure, you require funds, and the funds cannot solely be met by the tax revenues. Little bit of non-tax revenue, more of tax revenue, and a little bit of loans and borrowings, right? So these will comprise the whole public finance landscape of India, right?
So let me see if I've got this right, sir. I think you mentioned that roughly around 16 lakh crore was raised through direct tax collections.
Yes.
Roughly 14 lakh crore has been raised through indirect tax collections. Now that's 30 lakh crore. Out of that, 9 lakh crore has been distributed to the states. That leaves 21 lakh crores as what you refer to as being net tax revenue.
Absolutely.
Which is in the hands of the union. But the overall spending budget for the union is in the range of roughly 40 lakh crore. So the remainder of this 19 to 20 lakh crore is funded outside of tax revenue. And to do that, there's about a component of between 2.5 to 3 lakh crore which is raised through non-borrowing means.
Non-tax revenue.
Non-tax revenue. And then a remainder of 17 to 18 lakh crore is raised through borrowings.
Absolutely.
Which is a function of both market borrowings and non-market borrowings. So let's talk a little bit more about these sort of non-tax revenues and borrowings. What are the various forms of what you refer to as non-tax revenue?
So non-tax revenue, they broadly comprise the interest which the government gets, the dividend of the central public sector undertakings, and the profits which they make. So interest, dividends and profits, right? If they are plowed into the Consolidated Fund of India, they become the non-tax revenue. Apart from these three categories, we have various kinds of services which are rendered by the departments, right? For example, Department of Telecom issues licenses to the telecom operators. It also charges spectrum user charges. So license fees from the telecom users, from the telecom providers, right? Telecom service providers. From the purchaser of these spectrums, right? You get money, right? So those are non-tax revenue. Non-tax revenue for services would include administrative services, fiscal services, from coins and coinages, from defense services, from science and technology services, from roads, from shipping, from warehousing. So all these services, from organization like UPSC, right?
Right.
It also has some revenue, source of revenue. So those services, they also render some kind of income, some kind of revenue, right? So those are part of the non-tax revenue. Non-tax revenue is a small but significant part of the total received budget of the government, right? But tax and non-tax revenue alone will not shoulder the whole burden of expenditure, the expenditure burden of the government. That's why the loans and borrowings, right?
Okay.
So every year there is a borrowing plan of the government, right? And the borrowing plan also, it looks at the various requirements and the timing of those requirements of the government, right? And it makes the plan, the year-long plan, and either it goes to the market or taps into the small savings and taps into other savings and borrows money, right? And these are pretty delicate and very sensitive decisions which the government has to take, right? And there is the Fiscal Responsibility and Budget Management Act of 2003. It is very essential. Government has been advised that under the FRBM Act, your loans to the GDP should not cross 40% to begin with, 60% to begin with, and it should taper to 40% at the year end, right? And its fiscal deficit should not be more than 3%, and the guarantees which it gives should not increase beyond 0.5% of the total GDP. So there are good, solid, orthodox advisories rendered in this context. So the loans don't go out of hand.
So I have a number of questions relating to this. I think the first place to start is, you mentioned that the FRBM Act, does it cast an obligation or is it a general advisory? Is it a binding obligation?
It's an obligation.
Okay, so it's a binding obligation that the loan to GDP ratio of the government should not cross 40% at the end of the year.
End of 2025.
At the end of 2025.
2025.
And at the moment, I think it's just short of 50%, somewhere between 40 to 50% as things currently. No, actually, I'm not sure. So, what is the current?
No, it is much more than that. It's much more than that.
Right.
But the point is, there are also exceptions to the rule, and one major exception happened in the COVID time,
right,
in which substantial borrowings happened because of the need of the hour, right?
Correct.
But all governments are they are conscious, alive to the fact that the borrowings must be pegged at a level with the GDP, right? So that you are good and solvent enough to pay off your sovereign debt.
Got it. So just to give us a contrast, like, so in India's loan to GDP ratio is expected not to cross 40% by the year 2025. What would the similar loan to GDP ratio be, say, in a country like any of the developed countries? So you take a pick, like the US, for example.
I don't recollect at this moment, but they are much higher than India's. India's, the loan and the debt policy has been very consistent, very orthodox and conservative,
right,
which has stood India in good stead.
Right. Let's go back to non-tax revenue for just a moment. In addition to interests, dividends, profits, is there also theoretically a way for a government to raise revenue through auction of public assets or sovereign investments? Like we hear about sovereign wealth funds of some of these Scandinavian countries or these Gulf countries as well. Is there a similar model at all that is being contemplated for India? Is that something that can sustain or deliver a high quantum of revenue for the government?
Yes, disinvestment policy of the government has been a long-standing policy, and I think the government believes in disinvestment in full of the non-strategic from the non-strategic sector, and in the strategic sector, examples being the defense or roads or the telecommunications or railways, etc., to hold little bit of controlling interest at the holding company level, but leave the operations to the partner, right? So the idea is to get away and unlock the capital from the non-strategic sector CPACs and have small significant presence in the strategic sector alone, right? So disinvestment policy has driven the stake sale of many of the companies. You would remember ONGC, Steel Authority of India, Mazgaon Docks, then RCF, then GAIL, and IOCL, etc. And there are many more which are coming. Air India.
And most importantly, Air India.
Air India, for example, right? And there are innovative routes in which this investment has happened. Whether government has ceded controlling interest in some cases, it has retained controlling interest in some cases, depending on the significance of that particular CPAC in the whole scheme of things, right? But this investment is just not as a revenue augmentation model for the government, right? It's also to let that central public sector enterprise out in the open to face competition,
right?
Depoliticize the decision making at there, right?
Right.
And unlock the capital through competition, right? So this has been the main goal. Apart from this investment, we have the national monetization policy, right? The national monetization plan of 2021, in which the government expects that 6 lakh crore of revenues would be flowing through, right? And what is NMP? NMP is a kind of contractual arrangement with partners where you let him to enjoy not the ownership but the rights, right? So you basically lease him out,
right,
some services or some sectors of infrastructure so that it can monetize and return to you later, right? So you have highways, lakhs of kilometers of highways, you have railway lines, you have warehousing capacities, you have handling capacities in ports, airports, civil aviation, right? You have the telecom lines, right? And you have the gas pipeline
right,
of Gas Authority of India, of Indian Railways, you have sports stadiums, right? You have waterways. So you monetize those, the user of the assets, not the ownership of the assets. So this has been a good innovative plan to garner more revenues.
So in simple terms, how the monetization would work is, so the government owns a number of assets, as you said, pipelines or warehouses or highways or whatever it is. It leases out these assets to private players, presumably, and it collects a rental on that lease. So a user charge or a rental on highways or warehouses or stadiums or whatever it is. The private user will use it for a period of time, a long period of time presumably, and then return the asset back to the government, as in it will exit its lease. That's broadly how the monetization policy.
The idea is to let the brownfield, existing brownfield, de-risked infrastructure, which is created because of a lot of investment in infrastructure by the government.
Right.
You have the Sagarmala projects, right? Huge investment. And these kind of schemes and the programs, they have generated lot of infrastructure. Right. How to use those infrastructure for common good? So you have brownfield de-risked infrastructure assets, right? So they are through a specific model. The model could be own, operate and transfer, or you toll, operate and transfer, or through the InvITs or the real estate infrastructure trusts. Yeah, you can get them through unlocking the investment through these instrumentalities. It can happen. So the plan is not to depend solely on the disinvestment, but also to monetizing the existing infrastructure. Right. That has been the goal of the government.
So before we return to the tax landscape per se, is it hypothetically possible for non-tax revenue to sustain the expenditure requirements of the government?
Not possible.
Is that because non-tax revenue has already been maxed out, or is it just that the scale of expenditure in the short run as well as in the long run is just something which non-tax revenue cannot possibly address?
No, when the major refrain of the government has been to go for the disinvestment in a meaningful way, and government getting away from running of commercial establishments, to expect the government also to get more non-tax revenue, it is not possible, right? Both cannot work together. Government has to be large enough to run commercial establishments in order to get non-tax revenue. when government is getting smaller, the government machinery is getting smaller, the instrumentalities of the government getting smaller, stronger, and more resilient, right? And only the core government functions are being discharged by the government, then to expect the commercial establishment of the government to render you more non-tax revenue, it is not possible, and it is contradictory also.
So between the time you started in the service and present day, have you seen any trend in terms of which way the size of government is heading, in terms of, is it becoming smaller, is it becoming bigger?
There has been an effort of late to streamline and to rationalize the government as far as the ministries and the departments are concerned. Creation of departments has happened. It's not that it has not happened. The last was the Department of Cooperation. It happened, right? Then, but getting a synergy within the departments, right? That has been the main refrain of this government. Getting the maximum out of the functioning of a department.
Right.
That has been the goal.
Right. So let's talk about some statistics now, returning to the tax landscape. How many taxpayers do we have in India? And let's try and categorize them in terms of individuals, corporations, and I suppose residents and non-residents.
Yeah, so I'll give you the example of the income tax returns filers from 2013-14. 13-14 is a good way to begin because a whole new regime has come from 14 onwards. So we started at 3.60 crores of income tax filers. In 13-14 it was 3.60 crores. And today apparently it is 7.65 crores last year, right?
Right.
So we have doubled, more than doubled in the last 8 years, which is a very creditable number. It's a number which the government should be feeling proud of. And to give a stratified data as to how many individuals and how many this thing, I'll pick the example of 21-22, in which I will give the broad breakdown, in which out of the 7.14 crore of income tax return filers, we had 6.82 crores of individuals alone, right?
Okay.
6.82 crores out of 7.14 crore of return filers were individuals, right? Individuals are just not salary earners, but they could be doing business, right? They could be earning a profession, they would be earning income from a profession also, right? And or they will be business in a proprietary manner, right? And when it comes to, so ITR 1, 2, 3, 4, these are the individuals to file the returns in various forms, right? 6.82 crores would be the individual returns. The AOPs, that is the association of persons or the body of individuals or the limited liability partnerships or the registered firms, they comprise something like 16.70 lakh.
Okay.
Only 16.70 lakhs. The companies who do not be claiming a deduction under section 11, they would be around 9.70 lakhs, 9.70 lakhs, right? And finally, the ITR 7 filers. ITR 7 filers are what? They are trusts and funds and universities and political parties, etc. They comprise 2.25 lakhs, right? So the maximum number, nearly 96 to 98% of the return filers are individuals alone, right? About the non-resident taxpayers who are there, don't have the clear data as of now, but let me tell you, not only the numbers are increasing, but their contribution to the national tax kitty also is increasing over a period of time. At last year, their collection numbers from the non-residents was something like 1,44,000 crores, right? 1.44 lakh crores, right? Which is a huge number. And probably it rose from around 40,000 in 1819 or 1920 to 1,40,000 crores. So it has, the numbers has also.
Why is that, sir? What is the reason for that?
Many M&Es are coming to India. There are joint collaborations happening in India. And the permanent establishments, the PEs are happening more in India because of the better conducive rules and regulations and a business environment which is leading the global giants and global companies to get to India because of a good and feel good factors about running businesses in India.
So I just want to go back to that statistic that you mentioned. I believe you mentioned that out of roughly 7.14 crore taxpayers, tax filers, roughly 6.8 crore were individuals, which reflects, I think, around 96% of the overall tax filing population. Now, we are a country of 140 crore, and we have individual filers of just 6.8 crore. So naturally, someone who is not versed with the subject is likely to wonder why there's such a stark difference between our population and the number of tax filers, because 6.8 is less than a fraction of 140 crore.
Correct. Similar questions have come when we have tried to correlate the number of PAN holders, permanent account number holders, and the total tax payers, right? We have been asked that when your total PAN holder numbers are in excess of 50 crores, why only 7 crores are paying, right? And the normal response to that is that India's economy depends not solely, but a large chunk of the sources of income of a large part of India would be coming from agriculture, and that being outside the tax net, difficult to get more people into the tax net, right? Make their income taxable, because the nature of income which they earn, the agriculture class is out, and also because the India's per capita income is not that strong, right? Our per capita income is $2,200, right? Although it is increasing, and our tax slab is happening at around 5 lakh rupees, right?
Right.
So between the
So what is $2,200 in rupee terms?
$2,200 at 80 rupees, it will be around $1,80,000, right?
$1,70,000,
$1,80,000.
Yeah.
And your per capita is 1,80,000 rupees, and your the threshold for personal income tax is happening at 5 lakh rupees. So it's 2.5 times of your per capita. It does not happen in many countries, right? So because the government is cognizant of the fact that if they bring down the threshold for personal income tax to a lower level, more people will be affected, right?
Right.
So to answer your question, higher the prosperity happens, higher the per capita increases, right? The numbers will increase further. It's not that the government is lacking in its efforts to find more people to the tax net, right?
Right.
So you have innovative practices happening all the time. That suppose you get some money because of some contracts which you have signed, but you have not filed the return of income, right? So we have said that if you have not filed the return even for 1 year, but there is a TDS which has happened in your receipt, right? So next time the man who is paying you the money by way of contract, he will be deducting twice the amount, right?
Right.
Twice the amount. So we are the department has been trying through innovative means to get more people within the tax break, and also our the non-filer monitoring system, NMS, what we call that also is activated every year, so that more and more people who are otherwise taxable but not filing returns, they can be brought to the tax net.
Right, sir. Let's now talk about again the quantum of taxes. So earlier on we spoke about the broad revenue figures that were being delivered on account of direct tax collections and indirect tax collections. I'm now interested to know about the geographical spread.
Yeah.
So where are the centers of the country from which most tax revenues or maximum tax revenues are being generated?
Right. So historically, and even that is true of today also, Mumbai is the capital as far as tax is concerned, right? Delhi may be the political capital, but when it comes to tax, it's always Mumbai, right?
Right.
So Mumbai gives around 30 to 33% of taxes, total collections. Its collection numbers are in excess of 5 lakh crores this year.
So just Mumbai,
Just Mumbai.
just Mumbai, not even Maharashtra, just the
No,
Mumbai
just
zone
Mumbai, just Mumbai.
is delivering 33% of the overall
yeah.
income tax collection.
Income tax collections, right?
Income tax and corporation tax collections
Absolutely.
together. So I think you mentioned that the figure was roughly 16 lakh crore
Yes.
for the
Correct.
22-23.
Correct.
And you say that around 5 lakh crore, little more than 5 lakh crore is being delivered just
Mumbai alone.
Just Mumbai.
Mumbai alone,
Okay.
right? And below Mumbai, we have two cities, vying for the second position. We have the Bangalore and Delhi, right?
Okay.
Bangalore and Delhi. Then you have a configuration of three cities who are trying to get to the third position. You have Chennai and Hyderabad and Pune. They are 3, 4 and 5 kind of position. Then you have Ahmedabad, Calcutta, Chandigarh. They are also very strong when it comes to the collections. And then you have Kochi and you have Bhubaneswar, you have Patna and Bhopal. They also give some meaningful contribution to the national tax kitty. But again, the prime mover of the national tax map would be Mumbai, Delhi and Bangalore.
So, so like you said, for Mumbai, it's 5 lakh crores. What would the corresponding figures be for Bengaluru and Delhi?
I think I don't have the numbers, but Bangalore and Delhi would be close to 2 lakh crores or in excess of 2 lakh crores each.
So, roughly 12.5% each of
Yes.
the overall direct tax kitty is coming from
Absolutely.
Bangalore and Delhi. Has this always been the trend, in the sense, is it always Mumbai, Bangalore, Delhi which has dominated the direct tax collections, or has this been a change that you've seen in recent times over, let's say, the last 10, 15, 20 years?
No, like Bombay has been the prime, prime component
Right.
for the tax collection overall, right? But Bombay's share in the national tax kitty, I made a study that from 2008 onwards, from 37% in 2008, it has fallen to 31% right now, right? That's because Bangalore and Delhi and Chennai and Hyderabad and Chandigarh and Pune, they are catching up,
Okay.
right? They are very racing at the heels of Mumbai.
Right. So then let's talk also about the fact that India has a federal structure or a federal polity, or at least a quasi-federal structure. We have the union and we have the states, and the constitution recognizes both of these as being separate, distinct components of the Republic of India. Is it only the union that can collect taxes, or does a state have any taxing powers, or do they have the ability to collect taxes?
Yeah, states do have power as much as union has the power to tax and to levy and to impose a fee or a cess. Even the states do have that power. This is a power which is derived from the constitution.
Right.
Not just the state, even the panchayats also have the power, which will be authorized by the state legislature.
Okay.
Under Article 243H of the Constitution, the panchayats have the power to levy tax as authorized by the state. And by the 72nd or 74th Amendment, we have the municipalities under 243 capital X. They can also impose taxes as authorized by the state government.
Right.
What much and what kind of taxes are levied by the union and the states? They are defined by the constitution in Schedule 7, right? You have the union list and you have the state list. And in the union list, you have entry 82, 83, 84, 85. Income, solely the preserve of the central government, of the union. Right?
Right.
Then you have the excise duty on petrol, motor spirit and tobacco, right? That will be the union. You have customs, that is union. And you have the corporation tax, that is of the union. And when it comes to the state list, you have entertainment tax, you have tax on profession, you have the octroi, you have the state sales tax, you have the state VAT, right? and you have the transportation tax, that is a vehicle tax, the duty on electricity, they are all defined in the constitution.
Right.
So the state cannot impose an income tax, neither can the union impose a vehicle tax in a state, right?
Right.
So the turf is very clearly demarcated and nobody transgresses anybody else's territory.
So there's a clear distinction, and just again to ensure that I've got this right, the Constitution grants taxing powers to both the union and the states. The 7th schedule to the Constitution defines what these taxing powers are in terms of the things that can be taxed by the union and the states. So you have the union list and you have the state list. We also now have provisions in the Constitution which say that panchayats and municipalities can impose some form of tax themselves, provided that those taxes are authorized by the state legislatures. But presumably, the items on which the municipalities and the panchayats can impose tax are also circumscribed in a sense through the state list, because they cannot exceed the power of the state list. So it's a function of whether the state is distributing those powers to the municipalities and the panchayats. So I think it becomes quite clear from just that little analysis that naturally it's the union that is generating the lion's share of revenue between the union and the states. And does the state actually, or do states actually raise enough revenue to fund their own expenditures? Are they self-sustaining administrative units, the states?
No, there is what we call a vertical fiscal imbalance. It happens all the time. Even the union does not garner so much of taxes so as to fend for itself. So it has to do some bit of loans and borrowings in order to balance the budget. So also the states, it's just not that the union does has the privilege of having all the money to itself. The states also have limited scope to generate the kind of taxes which solely can take the burden of their expenditure commitments, right? So the states, apart from its own tax revenue, has other ways of getting the money. One is under Article 270 of the Constitution, where the divisible pool of taxes of the union, that is the income tax, income tax, and corporation tax, and the indirect taxes, they are divided between the union and the states, right? Under Article 270 of the Constitution, right? So that money, substantial amount of money, nearly 41% of the total divisible pool of taxes, it goes to the states, right? So that becomes one of the many components of sustaining a state's revenue, right? So you have the state's own tax revenue, then the contributions by way of the what you call the vertical devolution of the allocable resources from the center to the states, the tax pool. Then also these unions grant in aid also, that also is a serious component in the revenue receipt of the states. Then also the states also have the non-tax receipts also. It's not that the union only has non-tax receipts, the states have non-tax receipts, and in certain cases of states, one which I know of, where the non-tax receipts are more than the tax receipts.
That's very interesting, sir. So just to summarize, as far as a state is concerned, it has its own tax revenues.
Yes.
It has the state's share of union revenues. It has grant and aids from the union, and it also has its own components of non-tax revenues.
Absolutely.
So there are four components generally of the state's revenues.
Absolutely.
And just so very quickly, could you give us a broad? I know each state will vary. I'm also very interested to know which of these states is it that has more non-tax revenue than tax revenues. But broadly, what would the shares of these four components be for each state? So its own revenue, its own tax revenue, its own non-tax revenue, grant and aids from the union, and the money that is devolved upon the state.
No, we'll have a separate topic, separate discussion on this topic.
Right.
But the state's revenues and the flow of the revenue, the expenditure plan, etc., it follows more or less on the pattern of the union.
Okay.
The FRBM Act, which is applicable to the union, is also applicable to the states. The states have their own FRBM Act, right? So they impose upon themselves the obligations to stay within limits, not borrowing beyond a limit, not issuing guarantee beyond a limit, right? Keeping the fiscal deficit within check. So these are all state FRBM Act.
So just to summarize, it seems that there are 4 different components of the state's revenue. So it's the state's own tax revenues, the state's share of the union revenues, grant in aids from the union, and the state's non-tax revenues. Could you maybe give us a broad idea of what these components are in terms of percentage terms, generally for the states? I know it will be different for each state, but is it possible to have a broad sense?
Very difficult at this point in time. We should have a separate full-scale discussion on the state's budget and who all are faring well according to the parameters set out.
Right. So one other thing that we should maybe talk about is the politics of taxation. Now, every election season, invariably, you will hear someone or the other say that such and such state is sending so much of money in terms of revenue or contributing so much of money to the union exchequer, but is only receiving a fraction of that back from the union. What are your thoughts on firstly this line of argument that is made, and secondly, does it hold any merit, and how do you respond to this kind of argument?
No, this is entirely a political argument, and it does not hold any merit. Why I am saying so? That the allocation of revenue from the center to the states is constitutionally arranged, right? So you have Article 270, which lays down the principle that there will be some divisible pool of taxes which will be shared by the state. And who will do this kind of allocation? Article 280 of the Constitution would say that the Finance Commission will do that. So you have Finance Commissions, we have 15 commissions so far. So you have the Finance Commission making that particular percentage which will be allocable to the states after series of discussion, after years of research, they come out with their recommendations. 15th Finance Commission, which is the last one from 2021 to 2026, it made a recommendations as similar to the last year, similar to the last commissions. 41% of the divisible pool of taxes will go down to the states. So this is what we call that vertical allocation.
Right.
Then you have the horizontal allocation, that is among the states. So what is the allocation ratio? These are set out in broad detail and in minute details by the Finance Commission. So like this year, the yardsticks, this last Finance Commission, you have the income distance, that is what is the average GSDP of a particular state, that is what is the average GSDP of that per capita GSDP, and how far distant it is from the highest GSDP. Right? So poorer the state, greater is the amount of resources needed.
Right.
So that is a factor, right? Then population is a factor, right? And then the forest cover, that also is a factor. Demographic performance also is a factor. If a state's population is uncontrolled, it will be rated lower as compared to a state where fertility is controlled, right?
Okay.
So there are various factors which are very transparent, everyone to see those things. So the horizontal devolution to the states, the allocation of resources from the center to the states, it goes through a clear-cut, transparent process, right? So to say that there has been, some kind of misallocation of resources, I think it is incorrect.
So 2 follow-up questions to that. Firstly, do you have states that protest the recommendations of the Finance Commission? Does this happen?
Not to my memory. I don't remember states protesting against the allocation. Although the amount allocated, whether it should be 41% or 45%, that may be a point of contention. But the Finance Commission's report, which the government follows in principle, So that remains more or less largely uncontested.
So you say that in terms of that there might be some contest around how much of the union revenues in general are allocated for overall distribution to the states, but in terms of the individual distributions to the states, you at least are not familiar.
No, absolutely unaware of such situation.
Right, and each of the states is allowed to make its inputs for the purposes
Absolutely,
of these.
it's absolutely it's a kind of a cooperative, cooperative and largely depend on discussions and deliberations within the commission with the stakeholders, with all the states and Niti Aayog. They will be partners in the whole discussions. So nothing is hidden. In your words, nothing is hidden from this kind of deliberations, and the final conclusion is dependent on how good the states stand out in the parameters and the weightage given to each of those parameters.
Right. So have you ever been involved in either these discussions or in terms of providing inputs to the commission or to the people who are involved in the discussions that are that take place at the commission?
I would have given some feedback or some data points to the Finance Commission in course of my duty earlier.
Right. So now we've looked at various kinds of taxes, we've looked at the instruments of raising public finance, we've looked at the different categories of taxpayers, we've also looked at the geographical spread of taxes and the mechanism of revenue sharing between the union and the states and horizontally between the states as well. Let's now talk a little bit about tax rates. Two terms that I hear very commonly are one, effective tax rate, and two, marginal tax rate. So could you throw some light on what these terms mean, sir, please?
Yeah, to put it simply, the marginal rate is the head note rate, the statutory rate, right? If you are to be taxed at 30% because you are falling in that bracket, then you fall in that bracket, right? But taxpayers also have been allowed to partake of deductions and exemptions which are legally available to them. So what bracket you should be falling into without claiming the deductions and exemptions, that is the marginal rate of tax, and what you end up after claiming the deductions will be the effective rate. For example, in 2021 financial year, the marginal rate in case of a corporate was 13.20%, right? 30% of tax and 4% of surcharge, so 31.20%. But we worked out that the average effective rate of taxes for corporates in India was 22.20%. Right?
So there's a spread of almost 10 percentage points.
Absolutely, because there are deductions, exemptions available to them. This is more because of a simple example which I am giving, is that suppose at a tax bracket of 20%, somebody is claiming a deduction of a rupee. At 20% bracket, he will get a tax break of 20 paisa, right? 20 paisa. But similar 1 rupee of deduction at the highest marginal rate of 30% will yield him a 30 paisa rebate,
right.
30 paisa deduction, right? So there will be always a marginal rate, which is the statutory rate or the act given rate, and the effective rate, that is the rate at which the taxpayer ultimately pays his taxes after claiming the deductions and the exemptions.
Right. So now I'm told, and you can correct me if I'm wrong, that at some point after independence, our top marginal tax rate was very close to 100%, and then it was brought down to 70%, and then it's come down further. So is that true?
Yeah.
And what was the thinking around having a 100% top marginal tax rate?
Yeah, so
and then why did they decide to bring it down?
Right. So in 1970s, it was 75% in excess of income of 2,50,000. In 80s, it was 60% in excess of income of 100,000. In 1990, it was 50% in excess of 100,000. In 1990, it was 100,000 in excess of 30%. Then I think in 2010, it was 30% in excess of 5 lakhs, and in 2020 it is 30% in excess of 10 lakhs. So, not only the highest marginal rate has been rationalized from 75% to 30%, but the threshold limit has been moderated from 2,50,000 to 100,000, now at 10 lakh, right?
Right.
So, whatever thinking happened during that time of putting a rate of 75%, can't laugh it away at this point in time, saying that it was mind boggling. No, you can't call it irrational. It could be rational and reasonable for that time, right? Maybe the needs of the nation and the government was much more compelling at that point in time, right? So, can't deride or can't laugh at the decision of those times. They had to be contextually read with the need of that time, the compulsion of that time.
Right, sir. But just on that point, I've also read around the same time there was some sort of a brain drain that was apparently happening, which was linked to the taxes. Was there any such connection between a brain drain and the top marginal tax rate?
No, not aware of that one. But the gradual curtailing, the lowering down of the tax rate has been because of the expansion of the tax base, because people paying taxes are getting more and more. Government's desire to tax at higher rate, that has subsided.
Right. So now, in addition to the tax rate, we also have things like a surcharge and a cess.
Correct.
So what are, a lot of people think of these as being add-ons to the income tax. So what are surcharges and cesses? Why do they exist?
Yeah, let me tell you that cess and surcharge, they are constitutionally provided. It is not because at the sweet mercy of the government that these are imposed. These are constitutional provisions. Both cess and surcharge is constitutionally mandated. Now, cess as a species, it has been there since 1940s, right? At one point in time, Indians were having 44 different kinds of cesses, right? And of those, I was a part of at least two I would be knowing of, in which I was hands-on. One was the Clean Energy Cess of 2010 Finance Act, right? In which coal and lignite production or import in India, it attracted some levy, right? We called it cess. But it was not a specific act to administer that cess. It was part of the Finance Act. Clean Energy Cess, and the money that was got from the cess, Clean Energy Cess, went to fund 3 or 4 departments, including Ministry of New and Renewable Energy, then Ministry of Environment and Forest. So there are 2 or 3, 4 ministries which were the beneficiaries of the Clean Energy Cess. Then you have the Research and Development Cess. This was an act of the Parliament of 1986, in which import of technology was saddled with a cess of 5% of the cost of the technology. This money, after collection and appropriated through appropriation by the Parliament, it used to go to an organization called the Technology Development Board, right? And that particular board used to employ this kind of these remittances under the cess for different projects for getting technologies to India and developing homegrown technologies, right? So R&D Technology Cess Act of 1986. So that is one thing. So cess is a kind of collection, right, which is also compulsory in specific situations, but where the money is used for a specific purpose, right? At this point in time, after GST, we have only 6 or 7 cesses which are there, apart from the education and the health cess, which is part of the income tax now, right? You have the road and infrastructure cess, which is also there. Then you have a cess on exports, that also is there, and there are few other cesses which are there, and then workmen's welfare cess, that also is part of the existing cess. Rest other cesses they have subsumed under the GST, right?
Right.
So it's no more there. So as far as income tax is concerned, cess is paid across all tax brackets, whether you are an individual or a company or a HUF or you are a cooperative society, whatever it is, you have to pay 4% cess, that is education and health cess, right? 4% on the amount of tax which you are paying, right? It is across the board, costs everybody, right?
Okay.
And when it comes to surcharge, surcharge was there earlier also, right? It's not that surcharge is not there, but surcharge in 2016, 2015, I remember, surcharge was 10% in case of individuals. It was 10% in excess of somebody earning income of 1 crore. It was increased by 2%. It was 12% in 2016. Remember, in 2016, you had the withdrawal of the wealth tax, right?
Right. Okay.
So to offset the loss from the wealth tax revenues, right? So we had a 2% increase. So later on, this 12% it increased to 15%, right? And we devised two slabs: 10% for income below 50 lakhs to 1 crore, and 15% for income above 1 crore, right? But in 2020, there was a wide range of diversified surcharge ratios. So you have a 15%, you have a 25%, 10%, 15%, 25% and 37%. So individuals earning more than 5 crore of income, they are now visited with 37% of surcharge.
More than 5 crore.
More than 5 crores. 5 crores. So 37%, the highest surcharge rate is 37%, right? So cess and surcharge. Cess, as I told, it's part of the government's efforts to get money for the projects, programs, or some end goal they have in sight, right? The purpose is written over there. Surcharge is across the board, right? So you have the tax plus the applicable surcharge on both the amounts. If you add up the amounts, then you add the cess at 4%,
Right.
and that becomes your applicable taxes.
Right, sir. Let's go back to that abolition of wealth tax in 2016 and the corresponding increase of surcharge from 10% to 12%. Has there been any study in terms of whether more revenue is generated through the surcharge of 12% versus the wealth tax that existed before that?
I believe that government will have some data on this one, but off the cuff I can't be, I don't have the knowledge as to whether abolition of wealth tax because of administrative reasons,
Right.
and low revenue yield, it has been offset completely or fully by the increase in surcharge.
Right. So, and if someone wants to know definitively what the tax rates are, what the surcharge is, what the cess is, where should they look, sir?
Every year when the budget is announced, you have a finance bill, right? Then the bill is passed, then it becomes a finance act. Now, the first schedule of the finance bill or the finance act is where you can locate yourself as to which bracket you get into, what taxes is relevant for that tax bracket, what kind of surcharge is payable on your income, and what is the cess, if at all it is applicable to you, if the cess is there or not, right?
Correct.
So you have to look at that. So first schedule to the finance bill and the finance act, it's a good point to begin with if you want to know the bare numbers, right? And if you want to know the changes, what has happened from the last year, you have to go to the specific clauses. There could be 3 or 4 or 5 or 6 clauses which would be of interest to you. Go to the specific provisions which have been amended or it has been modified. So, but to know the tax rate and the slab in which you fall, first schedule of the Finance Act, that is the go-to section.
So, and just to go back to cesses, I know you mentioned that some cesses became comprised in the goods and services tax. I know you also mentioned some other kinds of cesses which were imposed on, let's say, the import of technology in 1986. As far as the cesses under the Income Tax Act are concerned, have there been any cesses that were phased out once they completed the purpose for which they were imposed?
No, see, like R&D cess, the research and development cess, it was not being dovetailed into any other act. It was an act by itself, right?
Right.
But when it comes to Income Tax Act, the secondary and the higher education says and the health says. So I don't know whether whether income tax is comprising any other cesses earlier and which has been phased out. So I don't have any data on that one.
Right.
Sorry. Yeah.
So as we come to the end of this particular episode, I'm curious to know whether you have either seen or been involved in any tax policy change which has had a very significant cascading effect on the economy. And could you please tell us a little bit about that?
I would have known one, I would have seen one in my time, and I was part of two others which I would like to recount at this point in time. One is 1987 when the specter of zero tax companies having lot of profits and paying huge dividends to the shareholders, they didn't pay any taxes because of the deductions and exemptions as usual, right? So in 1987 budget probably, so we have the section 115J which was brought in, saying that if your taxable income is less than 30% of your book profit, then the 30% of your book profit becomes your taxable income.
Right.
Very innovative, can't say crafty, but very innovative, and it did not put a closer to the zero tax companies, but it regulated their functioning for a long time. We had different modifications to the zero tax provisions of 115J. We changed it to 15JA, then JB. So that has been pretty well crafted and well reasoned and good innovative measure. The second one was I was not there, I was not part of that whole process, but in Finance Act number 2 of 2019, 2019, you have section 115 BA and BAA, which were drafted one after the other, introduced in the finance bill in 2017 and I think in 2019. So this section 115 BA and BAA would tell you that if there is a domestic company which is in manufacturing and which is not claiming any deductions or exemptions, or which is ready to sacrifice its deductions and exemptions, then it can file the returns and pay taxes at 22%. Truth to tell, I was very skeptical about the move because I didn't know the numbers of companies who would be ready to forego the deductions and exemptions for 6 to 7% of the tax relief. But when the numbers came in 2021, I saw those numbers. Nearly 60% of the total corporate income, it has shifted to section 115 BAA. So that was a remarkable, and to me it was fortuitous, but the people who would have designed must have been aware of the data point which went into crafting and writing down that particular provisions. A small effort of 21-22 financial year was the updated return, right? Helpful to the taxpayer and also revenue generation in little bit to the government was section 139(8)(a). Earlier times, if you have not filed your return of income, right, and the time is gone, then you are never to file a return of income. You are debarred from filing a return of income. Although you say publicly that I have the money, I have the inclination and I will pay taxes, nobody would have accepted your return of income legally without the department issuing you a notice, then you filing the return and all those things, right? It was a kind of a defect within the legislation. So in 21-22, a little addition was made in section 139 saying that if you have missed out your return filing, or if you have discovered some omissions or some changes, you want to do some changes to your return which you have filed, then come and file within 2 years from the relevant year. Within 2 years, you come and file the return of income, but you have to pay some additional tax, 25% in the first year and 50% in the second year. It was a small step, mostly procedural in nature, but it has, I believe, great consequences, helpful consequences for the taxpayers. These 3 parts I would remember very fondly when it comes to innovative tax legislation.
So, and then as we conclude this episode, hopefully there are some people who have watched us or listened to this thus far and have developed some sort of an interest in taxation or fiscal policy or tax policy for that matter. If there's anyone who is interested in learning more about this or researching this subject, do you have any recommendations in terms of where they can look for additional reading or for research purposes?
I think any economic or business daily where there is a tax section, so that would suffice. And there are also websites and the government also through its social media campaigns, it also tries to get many things to the taxpayers side, and so follow what has been going on both within the department, in the department and across the public frontiers. So a lot of discussion go on, and particularly in the budget time, so that will keep you active during that time. So there are plenty of literature available, and I think a business daily, economics daily, and the tax supplement which comes in a week or 15 days, that's a good way to begin your tax sojourn, understanding the tax in a more inclusive and more deep manner. Thank you.
Mr. Mohapatra, thank you so much for your time. This has been the Tax Experience series of the Private Office podcast. Thank you so much for watching. Thank you so much for listening. If you enjoyed this, please do consider subscribing to our podcast. Give us a 5-star rating. Like this podcast, share this podcast, tell all your friends about it. Thank you.